It is the first signal taught to millions of aspiring traders, a simple intersection of two lines, presented as a key to market timing. The MACD crossover, and it is a statistical lie. This signal is not a key. It is a trap, engineered to prey on the uninformed, the hopeful, and the technically naive. It confirms a move that has already occurred, an echo of a battle that is already over. While retail systems bleed capital chasing these ghosts, institutional algorithms are reading an entirely different language hidden within the same indicator. They ignore the crossover. They treat it as irrelevant noise because they are not measuring the past. They are quantifying the present in order to project the immediate future. They are measuring the raw, unfiltered velocity of momentum. This analysis will deconstruct the crossover's fundamental flaw and then engineer, from first principles, a systematic trigger that does what the crossover cannot: detect the precise moment momentum begins to accelerate. To understand the deception, one must first understand the architecture. The MACD line itself is the difference between two exponential moving averages, typically the 12 and the 26. It measures the convergence or divergence of short-term versus medium-term trend. The signal line is then a moving average of the MACD line itself, a smoothing mechanism, a derivative of a derivative. By its very mathematical nature, the crossover event is a lagging confirmation. The price must move significantly for the 12 EMA to distance itself from the 26 EMA. Only then does the MACD line move, and only after the MACD line has moved for a sustained period can its own moving average, the signal line, be pulled across it to generate a signal. It is a chain of delays, a message that arrives long after the opportunity has passed. Observe the data. In ranging markets, the crossover generates a relentless series of false signals, systematically draining an account with transaction costs and small losses. A death by 1,000 cuts. In strong trending markets, it provides an entry so late that the risk-to-reward ratio is critically skewed against the trader. The bulk of the impulse move is already complete. The trader is left to buy the top or sell the bottom, providing exit liquidity for smarter, faster capital. This is the function of a lagging indicator in the market ecosystem. It creates predictable patterns of behavior for less informed participants. But the story does not end here. The fatal flaw of the crossover is not a flaw in the MACD itself. The tool is not broken. It is simply being used incorrectly. The predictive data has been there all along, hidden in plain sight. But before we reveal how to decode the language of the histogram, we must first reframe our understanding of what it truly represents. This is not a simple bar chart. This is a visual representation of the physics of the market. This is momentum velocity. The histogram is the mathematical difference between the MACD line and the signal line. It quantifies the distance between them. When the histogram is growing taller, the velocity of momentum is increasing. The trend is not just continuing, it is getting stronger. When the histogram begins to shrink, even if it is still positive and the trend appears intact, the velocity is decreasing. Momentum is fading. This is the critical leading information the crossover completely ignores. Look here. The crossover signal occurs after a 5% rally, a reactive signal. The histogram, however, provided the first clue. It made its trough, its point of maximum negative momentum, and then began to climb back toward the zero line. This was the moment of inflection, the moment the balance of power began to shift. This is not a lagging indicator. This is a real-time gauge of force. To think of it in terms of physics, the price is the position. The moving averages are the velocity. The MACD histogram, therefore, is the acceleration. A crossover strategy is like trying to drive a car by only looking in the rearview mirror. A strategy based on the histogram slope is like feeling the pressure of the accelerator under your foot. One is history, the other is immediate experience. The peak of the histogram represents the point of maximum momentum. The very first bar that is shorter than the preceding one is a warning flare. It signals that the driving force behind the trend is beginning to wane. The price may continue to drift higher for a few more bars due to inertia, but the engine is no longer firing at full power. This is the institutional exit signal. This is what they see, not lines crossing, but a quantifiable exhaustion of energy. But simple observation is insufficient. The human eye is prone to error and subjectivity. To weaponize this concept, it must be transformed into a non-discretionary, mechanical trigger. But before we assemble this velocity trigger, we must define its logic. Observing the peak is still a reactive analysis. We need to detect the inflection point itself, the exact bar where deceleration begins. This requires a second derivative model. We need to measure the rate of change of the rate of change. The engineering process begins now. We discard the MACD and signal lines from our chart. They are noise. We are focused entirely on the raw data of the histogram. The objective is to create a signal that fires the moment the histogram's ascent or descent begins to slow. The solution is remarkably elegant. A simple moving average of the histogram itself. This line, let us call it the velocity average, now represents the normalized momentum. It smooths out the minor fluctuations of the histogram, giving us a clear and objective baseline. The trigger is no longer a subjective interpretation of bar height. It is a simple, binary crossover, not of the MACD and signal lines, but of the histogram and its own moving average. The condition for a high probability long entry is now twofold. First, the histogram must be below the zero line, indicating that the price is in a pullback or bearish phase. We are looking for the turn. Second, the histogram bar must cross and close above its 3-period moving average. This is our trigger. It is the mathematical confirmation that the rate of deceleration is slowing, and the momentum is beginning to shift back towards the upside. It is the earliest quantifiable signal of a potential reversal. Conversely, for a short entry, the histogram must be above the zero line, in bullish territory. We are hunting for signs of exhaustion. The trigger fires when a histogram bar crosses and closes below its velocity average. This signals that the powerful bullish momentum is starting to fade. We are entering the trade at the very onset of weakness, not waiting for the entire structure to roll over and confirm it with a lagging crossover. The difference is not subtle. It is absolute. The crossover-based system is reactive, noisy, and consistently late. The velocity-based system is proactive, clean, and predictive. It filters out the noise of consolidation and identifies the exact moment of transition from one phase of momentum to the next. The lag has been surgically removed. This is no longer a discretionary art. It is a quantitative science. The trigger is defined. It is repeatable. It is testable. However, an engine, no matter how powerful, is useless without a chassis and a navigation system. This trigger is hypersensitive to momentum shifts, but it has no concept of the overall market context. And this is the final, critical layer of logic that separates a simple signal from a comprehensive trading system. To deploy this velocity trigger effectively, it must be slaved to the master trend. We need a filter. The 200-period EMA, a standard but ruthlessly effective regime filter. The rule becomes absolute. Rule 1. We only entertain long signals from our velocity trigger when the price is trading above the 200 EMA. Rule 2. We only entertain short signals when the price is trading below the 200 EMA. This single condition extinguishes the majority of low-probability, counter-trend signals. It forces our precision tool to operate only in alignment with the dominant market current. Now, the system is complete. 1. Context. Price relative to the 200 EMA determines our directional bias. 2. Setup. We wait for a pullback, identified by the MACD histogram moving into opposing territory. 3. Trigger. The histogram crosses its 3-period moving average, signaling the resumption of momentum in the direction of the primary trend. Observe the systematic execution. There is no guesswork, no emotion, only a logical sequence of conditions. The context is set by the filter. The entry is timed by the velocity trigger. Risk is defined. The result is a probabilistic edge, applied with relentless consistency over time. This is the difference between gambling on lagging patterns and engineering a robust trading methodology. The MACD crossover is not a strategy. It is a marketing tool for a flawed idea. It sells an easy answer to a complex question. The real answer lies deeper, within the calculus of the market. It is found not in crossing lines, but in measuring the acceleration and deceleration of force. The market communicates through data. Learning to interpret that data is the only durable edge. The logic is testable. The data is absolute. To continue deconstructing the market's core mechanics and building quantitative systems, subscribe to trade_logic_lab. Activate notifications. The next layer of the machine is waiting to be analyzed.